G'day everyone and welcome to this Hidden Gems webinar. Thanks for your time. Welcome back if you've joined us again or joined us before. If you're you're new to these events, don't be afraid to ask some questions. Today we'll be discussing the silica sands market, software as a service, technology, and of course iron ore. First up, we welcome Mr. Martin Crabb, who's the Chief Investment Officer, who's going to give us a keynote presentation. He's from Shaw and Partners. We'll be discussing the key issues facing investors in what is a very volatile market at present. Martin, thanks for your time. Over to you.
Thanks very much, Tim, and welcome everyone to today's Small Cap Hidden Gems webinar. I'm going to start, I suppose, in the clouds, and we'll get down into the detail of these interesting businesses as we go through the next half an hour or so. But I suppose just starting with the global macro situation, my role here is Chief Investment Officer at Shaw and Partners is, I suppose, to try and set the sails for our advisors and clients in terms of what sort of portfolio positioning they should be taking on, what the sort of risks are that they should be thinking about in terms of their portfolios and where the opportunities might lie. So at a very, very high level, we need to think firstly about playing offensively or defensively, or are we sort of leaning into markets or are we leaning away from them? So the things we really look at here are global growth. There's a number of different ways to look at that. There's things like the purchasing managers indexes or indices, such as the one that came out of China today that showed the Chinese economy is starting to reaccelerate after months and months of slowing down. So that's one interesting read on growth. There's obviously things like analysts' earnings estimates, and that's quite interesting at the moment because the economic data that's coming through shows that consumption spending in Australia and some other countries is holding up quite well. But we know that companies are getting very, very nervous about the outlook going forward. So what analysts are seeing from companies in terms of earnings estimates. And thirdly, really is leading indicators. There's a couple of groups globally that put together statistics that are designed to try and interpret whether they think the economy is going, whether it's speeding up or slowing down. So the Conference Board in the United States is one such group. The OECD in France is another one. So we look at those measures as well. Now, pretty much across the board, they're all pointing to slower growth. So we are seeing expectations of global growth continuing to slow. We're obviously hampered by supply chain issues, COVID restrictions, and very patchily coming out of COVID lockdown. So we are seeing global growth continuing to slow, and that's just, I suppose, one caution. The second thing we look at is financial conditions, which very simply put is it easier or harder to get money? And is it easier or harder to, more expensive or cheaper to secure that money? So if we think back in Australia 2 years ago, you could lock in a 4-year fixed rate mortgage for less than 2%. There were some of my colleagues that managed to lock in sort of 1.8, 1.9% mortgage rates for 4 years fixed. So that same loan today, a 4-year fixed mortgage, is more like 4% than 2%. So even though the Reserve Bank's only increased rates to 0.85%, mortgage rates in that sector of the market have doubled. And that's what we're seeing around the world. So we're seeing financial conditions, whether you're a borrower or you're a corporate or you're trying to access money, consumer lending, etc. All of these forms of credit are becoming more expensive and more difficult to get. So we've gone from having a world that was awash with money to is now getting a lot tighter. And again, markets don't like tightening financial conditions. So I suppose that's warning sign number two. And the last thing we consider in terms of the positioning is central banks. So central banks are pretty basic beasts. They have a dual mandate. They have to create as much employment as they can without overheating the economy and causing inflation. So right now, of course, you would know that we've got inflation sort of out of control. It's running at almost 9% in Europe, 8% in the US, 5 or 6% in Australia, and that's well above central bank's target band. So with full employment, it's pretty obvious what they're going to do. They're going to tighten rates, and again, the market doesn't like it when the central banks are tightening rates. We much prefer them to be cutting rates. You're better off buying shares in a recession than at the top of the boom, for example. So those three things are what we use to set the sails, if you like. And at the moment, we're just a little bit defensive. It doesn't mean we're not invested. We're pretty much fully invested for our clients, but we might be a little bit more defensive. We might have a bit more in fixed income and floating rate notes and a bit more in energy and these sorts of sectors that are inflation hedges. So the second part of the way we're guiding people is in terms of the allocation to stocks within a portfolio. So if I think of the Aussie equity market, we've got a bunch of stocks which have proven to be a fantastic hedge against the rising inflationary expectations we've seen in the past 6 or so months. So even though markets have been sold off in almost every region and almost every asset class in the past 6 months, the energy sector is up about 30%. So it has proven to be a very good hedge against inflation, not just this year, but also historically, because it's often the cause of the inflation is energy prices shooting up. So that's done very well. The utility sector, which is very defensive, has a lot of companies that can move their prices up by inflation. So think about Australian Pipelines or Transurban. They're all inflation linked, the revenues. So the utilities and the energy sector have actually gone up this year. Everything else, as you would probably know, is down, and in some cases down quite heavily. So we're just sort of moving, I think, from a concern about inflation hedging to a concern more about economic growth, because as I said earlier, companies are starting to get nervous about the outlook. And the major reason for that is these interest rate hikes and the impact of inflation. So anyone who's filled a car up with petrol in the past couple of weeks will know, the horror story of you going well over 100, in some cases $200 to fill your car up. And multiply that right across the food inflation we're seeing and so forth. And also, if you've got a mortgage, you're probably looking at a doubling or even tripling of your interest payments in the next couple of years as well. So people are getting very nervous about that. And central banks are obviously still fighting inflation. So the concern in portfolios is now shifting from inflation as the biggest risk to growth being the biggest risk. So really, you look at stocks that do well in a downturn, and they're typically businesses with a good business model, in a growth sector of the market, and they have the capacity to pass on higher prices to their customers. It's called pricing power. So again, we talked about the utilities. So APA Pipelines Trust, 100% of their revenue is linked to inflation, and yet it doesn't cost them a lot more to run their pipelines. Transurban with the toll roads, 80-90% of those tolls are linked to inflation, doesn't cost them any more to run the road. So they're really good investments. But we're also thinking in healthcare, things like healthcare equipment such as ResMed or CSL in the pharmaceutical space. Those companies do well. Amcor in the industrials area have very good pricing power because of the nature of their business. Brambles in the pallets. So there's quite a few companies that will do well, relatively speaking, in a downturn. So I suppose to put that in a nutshell and to pass back, just a little bit more defensive on the positioning, just being a bit more cautious. Markets will probably continue to be volatile. So we're staying defensive within equity portfolios, maybe thinking more about, am I recession proof? Is my business recession proof? And I'm sure some of the stocks we're here today will have a pretty good growth story, should see them perform well during a downturn. So with that, I'll pass back to you, Tim.
Thanks, Martin. Thanks for that. It's always good to get an expert's opinion on what is a very volatile market. Okay, next up we have VRX Silica, ASX code VRX, market cap around 73 million. We have with us Bruce Maluish, who is the managing director. The company's focused on supplying the global demand for silicon sands. Bruce, over to you. Thank you.
Thanks, Tim, and thank you for giving us the opportunity to have a bit of a chat about a product that is not well known and not well understood, despite the fact that most people are probably surrounded by it. Next slide. You can read this disclaimer on the website or on this avenue here. We've got 3 very high-value silica sand projects in WA. Now, WA is a good region to be operating. We've got over 1 billion tonnes in resources, and we're well down the track with all the planning, heritage, environmental studies, because we started on this in 2017. We have signed up an initial offtake for foundry sand into South Korea, and there's a lot more potential there as well, and we're in discussions with quite a number of other companies. First cab off the rank will be Arrowsmith North, and that'll be followed by Musho and Arrowsmith Central. We've got mining leases all over the project, so we're heading down the track of EPA approval and mining approval. But infrastructure is basically in place. Really, this is initially a silica sand export, but we have the potential for glass manufacturing and other downstream industries in Western Australia. We'll be working on all of those at the same time as trying to get all these approvals. Okay. Silica sand is the most used commodity on the planet after air and water. About 50 billion tonnes a year of silica sand is used. 49.5 goes into concrete. And concrete is the main issue facing silica sand suppliers into the glass making industry. Glass making, but also it's silica sand is in the monitor you're looking at. There's a thin film on it, there's LCDs in it, there's a backing plate on it, and the plastics around it all contain silica sand. Neon tubes, all sort of lighting, paint, hard plastics. There's innumerable products that are produced that include silica sand. Now, not all have very high tonnage requirements, but certainly glass making for flat glass, which includes automobile glass, but also container glass. Within Asia, it's about 130 odd million tonnes a year, and it's growing at sort of 5-6%. And 47% of the world's glass is made in the Asia Pacific. So it's a finite resource. All the silica sand that's known in the world that's suitable for making glass is finite. It's all well known. It's not like you can drill deeper and get more. But the main issue facing most of Asia at the moment is most of the high quality sand is being dredged from freshwater rivers and lakes, which is not sustainable. And most of those Asian governments are ruling it out. So it's become quite a tight supply situation, and the demand is increasing. So we're trying to position ourselves in the right place. We're WA-based company, ASX listed since 2010. We've got the three projects, Arrowsmith North, Central and Maluish. We actually have another project that we're about to develop down near Esperance. But each of these sites actually produce a subtly different quality sand. And when I say quality, it's not just the mineralogy of it, but it's also the grain size and shape. So Arrowsmith North is suitable for the foundry market, which is a surprisingly large market, because it's the right size and shape. Now, you can't make size and shape, it all depends on the resource you've got. But it also has quite the mineralogy that's suitable for flat glass and container glass, as is Arrowsmith Central. Maluish, though, is much higher quality. It is it's in the very high quality, so it can be used for producing ultra clear glass. Ultra clear glass, the biggest demand is for the cover glass that goes over solar panels. That's, as you can imagine, it's a huge growing industry. But so each of these projects will be supplying into different markets. They're not competing with each other. They've all got established infrastructure with power, water. Railway lines are adjacent to each of these projects. So this is set up for bulk commodity export. And our planning and permitting is all very well advanced in Arrowsmith North. It's a small board, only 4 members in the board. We've also got a commercial manager. Yanil Kim is our marketing manager. He's based in KL. He's been involved for more than 16 years now of selling and silica sand. He knows the market extremely well. Share price is down a fair bit over the last year. When we're at this stage here where we're getting EPA approval, it doesn't get a lot of news flow, so the share price will always drift. But we've got adequate cash in there to get to the point of decision to mine. EPA approvals are long-winded and terribly frustrating, but they don't cost a lot of money. Top 20 is pretty tight. So we're in reasonably good shape to get this all these projects to the point of making a decision to mine. Arrowsmith North, with the way approvals are going at the moment, we expect to be able to get production some around 2023. Depends on the environmental approvals, but we're well down the track. But it's 200 odd million tonnes. This is going to last 100 years. So even though the approvals take quite some time, it'll be a very, very long-term project, and we won't need to go back for approvals for about 30 odd years. We're looking at exporting about 2 million tonnes or producing 2 million tonnes per year. We've actually developed a processing circuit that is fairly unique, not using spirals, but we're able to lift out all the, I guess, the other components that we don't want in the silica sand, and we're able to produce a product that is suitable for the glass market. We're in the process of revising capital estimates. The last capital estimate was in 2018. So we need to revise that. There's been quite an impact on the price of steel in that time, and most of the plant is steel. The railway line from Indiaba to Geraldton, it's adjacent to the projects. We have access to that line. We've in discussion with ARC Infrastructure, who own that railway line, and also we've got an MOU with Geraldton Port. We've already completed the water bore. It goes in the Arrogate North. They can produce about 50 litres per second, and we need about 30 litres per second, so we've got plenty of water. Brand Highway, we're in the final throes now of getting approval for the intersection with Brand Highway. And we've got a gas field right next door to us. The Waitsia gas field is next door. So we would like to think that in the longer term, we'll end up with a gas-fired power supply with some sort of hybrid arrangement with solar. We've developed this as well. It's called vegetation direct transfer. And basically, we're taking out a sod of topsoil, about sort of 3 metres by 3 metres by 400 mil deep. All the vegetation in our operating areas, or the critical vegetation, is all very small grasses, sedges with shallow roots. So this picks up the sod, and we put it back behind us where we've been mining. It's taken quite a while to have everybody understand what this process is about. It's been trialled before very successfully, and we think this will give us the best outcome we could possibly get for rehabilitation. As you can see, this bush that's here is about waist high. So it's all the little grasses and sedges around there. They're recalcitrant type species. So they can have a look at that methodology on the website. Arrowsmith North, it's been a long-winded mining approval rate. We've had confirmation under the EPBC Act that they'll take the state accredited assessment. It's what's called a PER assessment, level of assessment. We had the environmental scoping document approved in March. We lobbed the last document that we put in the ERD on the 14th of April. It's due to be published at any moment for about 30 days. So after that, we'll have a better idea on the timing for final approvals. Whereas Arrowsmith Central is a very, very similar operation. So we've had confirmation under the EPBC Act, and also it requires a PER assessment, and we just lodged the AEST a couple of days ago. So that's moving through the process as well. Processing, quite simple. It's really the key is attritioning, which is basically sand rubbing on sand, and hydrofloat. And then we can screen off different size products. So we can produce about 3 different products from Arrowsmith North. Mouche, just quickly, it's very high grade, low impurity. It's the same process, duplicate plant, and we're about to lodge the start of that process with the referral documents. They've been drafted up, and we're just looking at the right timing to lob that. But that's suitable for solar panels, the glass that goes over solar panels, which is it's creating huge demand. we've got letters of intent here for about 13 million tonnes a year, which we can't produce that much. Once again, the Banksias they're easy to propagate. It's really the low grasses and sedges that are suitable for VDT. So we'll be able to use the same rehab mining process here as well. We're conscious of our ESG requirements, and every move we sort of make is to try and reduce our impact and on the environment and also on the local community. So in a nutshell, we're really trying to place VRX and the production of silica sand in the right place at the right time. So very long life projects. We've got our projects in the middle of the Midwest, which is going to be renewable city, I think, in the next 10 years. So we could get access to renewable power and also hydrogen. The potential for high-tech glass production from Maluish is very high, and we're talking to 4 companies at the moment about maybe putting glass manufacturing here in WA. And the market for that sort of glass is just increasing significantly if we measure by the number of inquiries we get. So there's certainly that opportunity for downstream processing. So we think we're going to be in the right place at the right time.
Thanks, Bruce. It's always about the right place and the right time.
Yes.
Can you? I've got a couple of questions here. I've only got time for a few. Can you talk us through how silicon sands are priced in the market? Is there transparency around how contracts are priced?
Nope. You'll find that almost all the production of the products that use silica sand are held in big multinationals. So if you want to do any research on this, you can research the supply side of it, and there's plenty of articles around describing the issues that are around the supply side. But the actual final product size, it's almost impossible. And when I say 47% of the glass manufacturing is taken in the Asia Pacific, the bulk of that is China. So it's almost impossible to look at corporations in China and see what they produce. We are aware of all the market because of our marketing manager and his experience. But no, it's an incredibly opaque market, and there's nothing like the LME. And also you find that just a very subtle change in the quality or the size of the grains that you produce, it'll go to a different market. And there are literally hundreds of different markets for silica sand.
And the biggest suppliers in the world are China and India. Is that right?
No, suppliers of glass, yes, but not sand. There is no seaborne trade for silica sand other than Australia. Cape Flattery in northern Queensland is the largest single supplier of export of silica sand in the world. Every Asian country has banned the exports of silica sand because they're all concerned about their own domestic supply. Now, mainly for concrete, but that's affecting all the glass manufacturers as well. Just June 15th, literally a couple of weeks ago, Vietnam banned exports of silica sand, and they were the last country that allowed any significant exports at all. So you can't track silica sand movements by seaborne trade.
Right, that lays the challenge. Now, there's a question here. Your original plan showed Maluish would be advanced before Arrowsmith. Can you talk? It's one of the questions here. Can you talk through what are your plans, and have you kind of reversed those plans?
Now, Arrowsmith North was always going to be developed before Maluish, and really it's much more isolated than Maluish. That country around there has already had trials of the vegetation direct transfer method of rehabilitation. We wanted to establish that there, educate the EPA about what we're doing before we move to Maluish. Maluish is only 50 kilometres from Perth, so it will cop a lot more scrutiny, which we knew was coming. So we're developing all these processes at Arrowsmith North first.
And there's just one final question here from one of your shareholders. Is there any update on any offtake term sheets?
Not at the moment, but we've just sent off another whole bunch of samples to, I think we have 8 potential buyers. They've tested 1-2 kilos before. but they needed 50, 60 kilos for further testing. We haven't been able to provide that until we built a pilot plant. So we've just finished processing 1.5 tonne. So we're able to send out those larger samples, and they are required for them to finalise offtake. So they've only just recently been sent off. I expect in the next couple of months we'll sign up another couple of offtake partners.
And just quickly, what sort of capex are we talking here?
50 mil, 45, 50 mil, somewhere around there. I think our original estimates were sort of closer to 30, but increases in steel and almost all the components we need, it's got a kick up there, but it's relatively low capex, low maintenance, low operating cost, and it'll last an awful long time.
Bruce, that's all we have time for. Thanks for your time. Have a nice weekend.
Thanks, Tim.
Okay, next up we have AD1 Holdings, ASX code AD1, market cap around $8 million. We have with us Brendan Kavenagh, who is the CEO. The company is a technology company focused on creating and investing in market-leading software businesses. Over to you. Thank you.
Great. Thanks, Tim. Welcome, everyone. Thanks for your time today. We'll kick off today. I'll just run through who we are, our story, our business, a little bit about our model and growth strategy, and then tie it off with any questions. So if we just flip through to the next, look, normal disclosures apply. Look, this is our business. We're a portfolio of SaaS businesses. Our focus is to provide essential services within high growth markets. I'll talk more about the 4 businesses shortly that currently sit within the portfolio. To the left, 90% customer retention. We've got good solid annual recurring revenue and growing. And we've had good growth over the last few years as well. 125 customers plus, currently in 26 countries across North America, Europe, and Australia and Asia, and certainly a scalable revenue stream. And I'll get to our business model as well. Sticky customer base. We provide software as a solution technology. It is all about automation. It is all about convenience and efficiencies. Our board, who I'll introduce later in the slide deck, currently has 35% of shares on issue. So we're highly incentivized to build a growth story and make the most of current market conditions. So if we just move to the next slide, please. Won't spend too much time on this other to say this is the growth story of the last couple of years. Certainly, if we go back 3 or 4 years ago, some people might know us as Apply Direct, and I'll introduce that business shortly. But through acquisition and organic growth, we've brought the company to where it is today. We've got some key highlights in there in terms of multi-year contracts won, funding and placements secured in the last 12 months, customer growth, and the launch of new products. So I will highlight some of the key benefits of each of these shortly. But look, a busy few years. The company has spent time appointing a new board in the last few years, a new management team. So certainly ready to mobilise the business to continue growth and provide great return to shareholders as we move forward. Let's next slide, please. So these are the 4 businesses. If I introduce on the left the recruitment solutions businesses and mentoring. So if you see just down the bottom, we've got HR SaaS technology services, and that's how we're splitting the business up. And then to the right, in our niche SaaS services, so which is in the utility billings market. But if we start with Apply Direct was really brought about to solve a problem for government. And the problem was that, and we all know, in fact, we can't interact on this, but if I was asked the question, has anyone had any issues with hiring or attracting talent or retaining talent? I expect the answer would be yes. It's well documented that, the talent market globally, there's a shortage of skilled workers, there's a shortage of workers, more vacancies than there are people available to do the job. So we've got some real challenges. What's really important is that companies get their messaging right to market and that candidates have a great experience while they're applying for jobs and then being engaged by organisations and then being developed by organisations. So our HR technology products start, if you think of it as two bookends, where attraction is the first part of the bookend and development and retention is the second part of the bookend. That's where we fit. So back to Apply Direct, an inbound white label career site developed originally for New South Wales government. And the problem they had was 54 different departments were all going out to market with different messaging. There was no central source of information. There was no ability to grab the data and understand anything about their employment, what jobs, for example, they might have available from one central repository. So Apply Direct built the platform. It's alive today. If you were to Google I work for New South Wales, you'd see that. We also support the platform Careers Victoria. And the traffic, you can see there 7 visitors last year. I don't have the final numbers for this year, but it's similar, slightly more. It's a really powerful tool, career site platform for governments wanting to attract talent through one portal. So the candidate Googles a train driver job, for example, and they're directed into this website. They can then apply and it shoots off into what's called a CRM or applicant tracking system. So that's that business has been around for a while. We've reinvested in that and we're currently adding new customers onto that platform. Jobtail, if we look at Jobtail, Jobtail is a new initiative, entrepreneurial play. This is about bringing control back to anyone who's hiring. We know that job specs, last minute thought, pull one together, upload it, put it on a job board, maybe not, maybe go direct to network. We know that only about 30% of jobs are advertised and about 70% of jobs are filled directly through referral and network. So it's really important that messaging is clear, that companies, 200 or less or slightly more who may not be well resourced with HR, human resources, and may not have the time to recruit properly, a tool like Jobtail will certainly support them with there. And that's plug and play. So swipe the credit card, follow the templates, build your profile, build the job spec, add some video, send it out through your network, upload it to socials, whatever it is you choose to do. The experience for the candidate, really important. They get one message, they understand what the job is about, they understand what the culture of the organisation is about, and they can choose to apply or schedule an interview without leaving that page. Because lots of candidates, they need to leave a job ad to go and learn about the career. What's the, go to a website and have a look. 80% of applicants drop off in that process. Jobtail aims to, through better automation, better communication, improved messaging, aims to keep people in that application process and apply for jobs. Art of Mentoring. This is our hero. This was an acquisition back in October 20. It has gone from strength to strength. It provides a mentoring platform and it's all built around expert evidence-based mentoring. And so the content is a real differentiator for Art of Mentoring. It's been very well procured by highly qualified people and put into programs and design. So look, Art of Mentoring, and mentoring is growing. We all know about coaching. Mentoring is, arguably where coaching was 20 years ago. They're both similar in many ways, but it's good mentoring programs, provide much improved engagement in the workplace, which we all need to keep our talent. But it also, people under a good mentoring program are 5 times more likely to be promoted and 1.5 times more likely to stay in their jobs. So that's very exciting. We've had some really good growth opportunity in the US. We've added, a number of customers. We've got great channel partners. And we'll be relocating our CEO over to North America to be based in Austin to continue to build out and execute on a pipeline, which the good news is moving into FY23 is 3 times stronger than what it was for the same period last year. So we're really excited about what this business is doing. It makes a great difference for organisations, culture, performance, retention, and is a very powerful, simple to use platform. Utility software services, USS. It falls under our niche SaaS services, and it provides it's the engine room really for retailers, particularly targeted for new entrants into market. And then we grow. The business grows as new entrants grow. So it's a billing platform. So we all get our bills going up a little bit, I notice, and it's this business and this technology that generates those bills and sends. So that's the full business. That's as they are today. We might just go quickly to the next slide. This is the business model. So with SaaS, the beautiful thing about SaaS is that it is recurring. So we have a payment frequency of monthly, implementation fees. They vary across the different businesses, and the subscription fees also vary. You can see there. Lifetime value of customers tend to renew. So you may have seen earlier, we've got about an 85% renewal rate of customers across the business. It'll be stronger than that this year just passed, but very strong once the software is in and continue to service and provide it's meeting the business outcomes. We contracts get renewed. We might move to the next slide. Just a list of some of the customers currently growing. Part of the growth strategy is once in is cross-sell, particularly across the HR tech businesses. Is cross-sell, upsell. We have a very similar customer base and continue looking for those. And it's not just cross-selling across business, it's also upselling additional programs within the businesses that we sell in. So we might start off with running one mentoring program, word of mouth grows. We have a 90% satisfaction rate for the programs we run, and then other departments will jump on board. So it starts to become a little viral in those organisations, and great product. A little bit about, thought we'd focus a bit today on the HR tech versus the utility space, but that's the SaaS market. We know it's growing. Automation, digitization has changed everything. But I just thought I'd read out just a couple of stats on that. But in 2015, the SaaS market was estimated to be around a $31 billion industry. 2025, it's estimated to be at about 436 billion. It's currently at around 170. So there's huge growth in front of us. And then if we break that down into a vertical market and look at the HR technology market, globally estimated to be about 158 billion globally, whereas the online recruitment market is expected to grow from 28 bill there to 43. So enormous growth for good software, for good problem solvers, really, that can help solve the end-to-end solution or modular-based solutions that organisations struggle with that. Look, we find that a lot of customers are still working out of spreadsheets or email, and it's pretty common. And there's ways around that. We know talent is in top of the minds of many people across all levels of organisation. We know that there is a jobs boom, even though the market's tough at the moment. There is plenty of work. We expect that software will continue to get the attention because it does create efficiencies and cheaper cost to hire when done well. So the mentoring sector growing. The amount of interest that we have through demos and then conversion is enormous. And education and training through mentoring and automating that as much as possible is certainly growing in demand. So here, growing portfolio of global software businesses. So we've spent a lot of time in the last 12 months, both listening and understanding customer. building out our roadmaps, improving product, and making sure that our existing customers are happy, and taking those learnings into new customers that we're exploring with to build our pipeline. Offshore expansion, we've got real interest, particularly with Art of Mentoring. We'll continue to grow that, and we're pretty active in the acquisition space as well. This is the board. I won't go through each one, but as I mentioned earlier, very much focused on growing this business, making it successful. We've got great pipeline growing into FY23 across each of the businesses. We look forward to executing on that. Each of the board are very experienced businessmen, both in merger acquisitions, in growing SaaS businesses, in selling, and we've got our newly appointed co-founder and CEO Alex Richardson there on the left, who'll be on the right, who'll be moving to Austin over the coming months. So look, that pretty much brings us to a close, I think. If there are any questions, Tim.
Yeah, thanks, Brendan. We've only got time for one question, unfortunately. In regards to, there was a question around your renewing the Victorian government contract. Is there any update on that? And you've been there's been a lack of news lately. Can you give an idea of what investors or potentially new investors can expect from Newsflow moving forward?
Yeah, so Newsflow, we're well aware of that. We've been working, very hard in the background to generate new contracts and do a good job on the ones we have. We've got good flow coming. So New South Wales Gov was the renewal, and that's a great win. We're continuing to work with them on new programs, as we are with Victorian government. A lot of work going on in the background in terms of announcements there. We'll just have to wait. In terms of the other businesses, Jobtail, that we're looking at. We've got 70 odd customers signed up for pilot, so we're super excited by that. The feedback's been enormous. That'll be live late July, early August, and that's on track to make a real difference. Did I answer your question there, Tim? Was there anything else?
Yeah. No, that's all good. Thank you. That's unfortunately we have no more time, so we'll move forward with the other presentation, and we'll follow your story with interest and love to get you back on, Brendan.
Thanks, Tim.
Thank you. Okay, next up we have Magnetite Mines, ASX code MGT, market cap of around $80 million. We have with us the CEO, Stephen Weir. The company is in development stage company advancing the Razorback high-grade iron ore concentrate project located in Braemar, Australia's emerging iron ore mining region. Stephen, thanks for your time. Over to you.
Thanks very much, Tim, and thank you for listening to the Magnetite Mines story. On the next slide, please. This is our standard disclaimer. Our recent share price, we've been a little bit soft recently, just following a $15 million net rights issue, which we completed last month. We currently have a market cap of around $100 million and cash in the bank of about $20 million. Next slide. This slide shows the breadth of experience we now have at Magnetite Mines. A couple of months ago, Jim McCurley and Paul White joined our board, and most recently Simon Wonke had joined in the last couple of weeks. Simon has got over 40 years of tier one mining company experience, and most recently he was the chief executive of ArcelorMittal's mining business. We've got a great breadth of experience of the board. I've just recently moved in as chief executive officer. Mark Eames is now our chairman. He's got experience with Glencore, Rio and BHP in iron ore and other bulks. And Trevor Thomas is now heading up our study director. And Trevor's been with Magnetite Mines for over 12 years in a geology role. Thanks. I always enjoy presenting this slide. This shows the the premium that the 65% FE benchmark is achieving over the standard reference 62% benchmark price. And the burgundy coloured line shows the converse, the discount that the 58% product is achieving against 62%. So it's undeniable that premiums are widening for high-grade products. We're going to produce a 68% magnetite, high-grade magnetite concentrate. So we're anticipating an even higher premium than the 65% reference price. And this is all a function of the decarbonisation of the iron ore industry and the iron and steel producers seeking higher grade concentrates or higher grade ores to reduce the consumption of coking coal. Next slide, thanks. We have a very, very large resource base at Magnetite Mines. Total resources are 5.7 billion tonnes. 3 billion tonnes of resource at the Razorback Iron Project, which is the focus of our development at the moment. 1.2 billion tonnes at Ironback Hill, which is about 15 to 20 kilometres down the road from Razorback. And our new project, which recently acquired, Mustard Dam, 110 kilometres from Razorback. We've got 1.5 billion tonnes at Mustard Dam. It's a 2004 resource, I should add, at Mustard Dam. The resource is obviously in South Australia, located about 240 kilometres north of Adelaide. South Australia is an extremely good and supportive environment to be developing in. It's ranked in the top 10 in the world for risk under the Fraser Institute survey. Next slide, thanks. We're currently a long way through our definitive feasibility study. We plan on developing the project in 3 stages. First stage is 3 million tonne capacity plant. And I've got a schematic there showing the modules. That's 1, 2.5 to 3 million tonne capacity module you can see there. We plan on replicating that module 2 or 3 times to get to a final stage of 7 million tonnes of concentrate production. Next slide, thanks. Once again, this highlights the scale of our resource. We have a very, very large scalable resource. Stage 1 of our project development is going to rely on 8% of our mineral resource. We're only touching a fraction of our strike and an even smaller proportion of our total tenure area. Thank you. One of the benefits of the project is the fact that we are relying on existing infrastructure in the region to reduce our capital cost. So the first thing I'd like to talk about is the transmission line and power supply to the project. We're planning on building a transmission line about 120 kilometres long to the Bundy substation, which is located close to Robertstown, which you can see on the slide south of the project area. The great thing about that is that we'll be connecting into the Southeast Australian grid, which is forecast to have a reliable content of up to 97, or a renewable content, I should say, of up to 97% when we're in production. And I think that's quite an extraordinary number. The other great benefit is, of course, the cost of energy at the grid is considerably lower than the cost that competitive projects will be paying in Western Australia if they're powered by gas or diesel. From the site, we're then planning in stage 1 of project development, we're planning on trucking the concentrate to a rail siding, which will be in the area about 30 to 40 kilometres southwest of Yunta on the main Adelaide to Broken Hill railway line. We'll load rail wagons by front-end loader and transport the product down to Whyalla Port, where we have a conditional agreement in place with CIMEC, which we're currently developing to obtain certainty around our shipments through the Whyalla Port. Next slide, thanks. This slide talks to our the economics of our stage 1 and then stage 2 and 3 developments. I think it's important to add that when we're fully developed at stage 3, our expansion study shows that we have an NPV of $2.5 billion on this project, post-tax IRR of 27%. And importantly, we have an all-in break-even, equivalent break-even price of $40. In other words, that's the equivalent price of the 62% benchmark at which our project breaks even. These numbers have been provided to Woodmac, and they're putting us in the bottom quartile of iron ore producers on a value and use basis. So that's taking into account the premium that we're going to earn for our very high quality concentrate that we'll produce, and will mean that we're in a very competitive position once we're fully expanded. Next slide, thanks. Building an ESG platform is very critical to magnetite mines and to gain stakeholder support. I'd like to talk at this stage about the very real things that we're doing in relation to ESG. The first thing is that we've appointed a General Manager Sustainability, Alan Kane. We've talked already about the very high renewable energy component that the project's obtaining its power from. Second thing is that baseline studies that we've completed to date show that we've got no threatened species, which is a very positive aspect of the project. And finally, we've got a very active Indigenous engagement program with the Ngadjuri. The Ngadjuri have native title over about 50% of our project area, and we will be commencing Indigenous land use agreement negotiations with them at the latter end of this year. Next slide, please. So far, the milestones that we've achieved so far include release of our successful pre-feasibility study 12 months ago in July 2021. We've completed an expansion study for Razorback that shows that the business case improves as we increase the production levels of the project and we expand with scale. Our definitive feasibility study is progressing very well. We're about 70% complete. I think it's important to add that we're using tier 1 consultants for that study. So, for instance, our mining is being undertaken by well-regarded Australian consultants, AMC. Global engineers Hatch are looking after the processing plant, and GHD are looking after the non-process infrastructure for us. We've expanded our board, as I've talked about before, and recently we've completed metallurgical and shallow infill drilling at the Iron Peak deposit, and you can expect to see results in relation to that drilling coming out very shortly. On the permitting front, we've got a permitting pathway available to us, and we're planning on commencing the approval process at the latter half of this year. Next slide, thanks. Our indicative schedule has us releasing our financial metrics for the project at the end of the year, and in parallel, we're running a financing process. As I've talked about, we've got permitting and environmental applications underway. We're heading for production at the end of 2024, early 2025, That's of course subject to permitting and financing being available in the time shown. Thank you. So if I could just summarise the project at a very high level, we have a very, very substantial resource that we're developing. We've got a staged development schedule with low initial project capital and readily available access to infrastructure and power. We're producing a very high-grade iron ore concentrate that plays to the decarbonisation theme that's currently happening in the market today. And we're developing in a very safe and welcoming environment in terms of government approvals and acceptance of the project. On the corporate side at the moment, there's the key focus on looking at the project and making sure that we're unlocking project value for our shareholders and assessing strategic partnerships for financing. Thanks, Tim.
Thanks, Stephen. Quite a few questions here, actually. You recently, you and the senior management team visited the Razorback project. Can you give us some of the key takeaways from that visit?
Yeah, sure. Look, it was a great opportunity for the team to get together at site, and to be quite honest, it's the first time we've all been together. COVID's prevented that. Look, it became apparent that we've really got to reflect on the scalability of the resource that we have at Razorback, and we're thinking about ways to enhance project value. Two things that have come to mind. First is to increase planned production levels. We're beginning to think about that and questioning whether the current plan is optimal. And the second thing is product grade. Should we be thinking about looking at even higher grade products and capturing higher margins? So they're questions that we're thinking about and working on at the moment.
And just in regards to the DFS, is it still on schedule? And shareholders seem to be asking questions here around more updates.
Yeah, sure. Look, I understand that. The DFS is about 70% complete. There'll be updates coming out on where we're at very shortly. One of the issues is that we've been doing all that very hard engineering and test work over the past quarter. So there's been a lot of work going on and hard to make a series of exciting announcements about it. But we're anticipating producing our economic results from that DFS at the end of this year.
And shareholders can be impatient, obviously. Can they expect any more news on kind of leases with ports and funding and offtake agreements and those sort of things?
Yeah, look, we've had preliminary engagement with investors. We've had some good feedback on the project. We've got port negotiations underway. We've got design of power infrastructure underway. A lot of those conditional agreements and preliminary agreements will start to formulate through the back end of this year. And the answer is yes, we'll have more news on financing as the project progresses.
And how closely do you monitor the iron ore price? Given its recent weakness and kind of a shutdown in China has had an impact, does that change the kind of medium-term strategy at all?
No, look, we've got a long-term sort of positive view on the iron ore price, and I think you've got to remember that we've got a resource here that actually that's going to drive a project with a mine life in excess of 30 years. So we're not distracted by too much short-term volatility in the iron ore price. I think it's important to say though that the iron ore price is still trading above the long-term average, $110, which we're using as our base case iron ore price. the premiums that are being obtained for high grade iron ore are still intact, and as I mentioned before, widening as the world decarbonizes. Our fully expanded equivalent break-even price is $40. So, I think we're going to have a very competitive project once it's up and running, and so the short answer is no. We're not too distracted by short-term volatility, and we're staying the course.
And just in terms of that project status, there's a question here: does Magnetite Mines plan to apply for major project status?
At this stage, we don't, and the reason we don't is that the project is being developed in South Australia under the terms of the State Mining Act. So at this stage, we don't see actually any benefits for applying for a major project status because our approvals pathway is very clear. We've met with the representatives from the government. We've got government support for the project. So whilst that might be a good addition to our marketing and positioning, from an actual project development point of view, at this stage, it doesn't seem that it's required or would provide any benefit.
Great, Stephen. That's all we have time for. There's quite a few more questions. I'll shoot those through to you over the weekend. Thanks for your time, and we'll catch up later in the year.
Thanks, Tim.
Great, everyone. Thanks for your time. I hope you enjoyed this Hidden Gems webinar today. Have a good weekend. We'll see you next week.